Hey guys, it's Cris and Court here with Realty ONE Group Integrity. We are here with Ben and Mayela with Fairway Home Mortgage, and we are here to go over some questions concerning VA and FHA, some myths, kind of maybe debunk some of them, answer some questions that you may have or some that you didn't know you had. All right, so getting ready to buy. We have a couple questions here. What is one thing that a buyer should do when they're getting ready to buy?
They should get pre-approved, make sure that also their loan officer is going to be available on nights and weekends, because that's, as you guys know, when offers are made. So having someone that's available, experience, and getting a solid pre-approval so that way you guys know, what price range to be in, what they're comfortable with, and, narrow down the home search.
So the next question, what's the difference between getting pre-qualified and pre-approved?
Getting pre-qualified is the upfront part where you're providing your financial documents to the lender, they pull your credit, they let you know what you're pre-approved for or pre-qualified for. So I would say the pre-approval process is when your loan actually moves into processing. There's a property, documents are looked at by a processor, then an underwriter, and then you'll get your initial pre-approval versus the pre-qualified stage is just like before you're making an offer on a house and under contract.
I would say the biggest difference is whether an underwriter has looked at the loan or not. So we do this pretty often with jumbo loans, right, Ben, or complicated loans. And that makes the biggest difference is a pre-approval as an underwriter is involved, not just the loan officer.
Yeah. And pre-qualified could be a scary thing. We see this a lot where someone's pre-qualified and it's not a true, qualification. Sometimes they're missing documents, especially on self-employed, where the lender hasn't looked at their tax returns, and then it gets under contract and it's no longer, a valid pre-approval or pre-qualification.
Okay, so on the real estate side, when you are receiving an offer, so it's a really good idea to take a look at that pre-qualification form and really look at the boxes of what's checked and ask questions and call the lender if needed. Okay.
Yeah, I think the Arizona pre-qual form is very important, even though they're further along in the process with the pre-approval. I still think if you have that pre-approval, still submit an Arizona pre-qual, because then that actually is going to give information. Is the buyer contingent on a home? Do they need seller concessions? I have seen where it's come across where they were asking for seller concessions, but the pre-qual actually didn't support that, and it said that the buyer actually could go without seller concessions. So I think if you have the pre-approval, it does make it stronger just for the buyer, but adding that pre-qualification form is an important key component, especially when you're on the buyer side. You want to make sure it actually supports what you're trying to offer, and then on the selling side, you are actually reviewing that pre-qualification form as well, because then you could catch things. So thank you.
Okay, so this leads to the next question. What's the biggest mistake a first-time home buyer makes?
So I would say open up new credit. Even the littlest thing can create problems. We see a lot of times Kohl's is one that we always run into. You get a discount on your, you get 10%, or Target. Sometimes they're very sensitive with their debt to income ratios, and they'll go out and buy furniture and stuff for the house, and then it affects them qualifying, because now we have to hit them with a monthly payment. The big ones, of course, are like the auto loans, stuff like that, that is a huge debt that can change things drastically for
You know which one I've been seeing a ton of recently? We've actually just been dealing with this with so many clients recently, is on websites like Amazon or Instacart or anywhere that you're purchasing anything online. You can now do it with Affirm or Klarna, and it says pay it over 4 installments, pay it over 6 installments. We have to document that, and that becomes a liability on your loan. And people don't think that because they're not necessarily running your credit, they're just getting your bank account information. But when we review bank statements, we see Affirm coming out. That now becomes a liability, and that is a huge pitfall we've been seeing. and a lot of it recently.
Right.
Now, are you guys looking at that total affirm amount, or are you just looking at that monthly payment and only taking that into consideration?
It's the monthly payment, but a lot of those affirms are like every 2 weeks.
Mhm.
They'll hit, and sometimes it's big because they're like, oh, I'm paying it off in 90 days, so it's not that big of a deal. But these 2-week installments
can
could
be.
be 200 each, right? So now you
Okay.
add those up, and that's 400 a month essentially, right? So it's like, it can, yeah.
It can
That'd
really
be
mess
fun.
it up.
Yeah.
What about you guys? What are some of the pitfalls that you see?
Furniture. So it's the same thing as the opening up new line of credit. I've had a couple clients that, oh, I just went and ordered a bunch of furniture. I can't wait. I'm like, how did you pay for that furniture?
Yeah.
One of them, they did get a line of credit, but fortunately they had good income, and the lender had to kind of look back at things, but it didn't affect them. So that's the biggest thing. I see it the same. Yeah. And I just try to make sure that I tell my clients in the very beginning, don't go shopping for cars. Don't buy furniture, don't open new credit. So I have that conversation early on. Sometimes I forget, and then they still come to me, oh, we got a new couch being delivered. And I'm like, well, we haven't even closed on the house yet.
Yeah.
Do you think the sellers will let us move in our furniture?
Yeah.
I'm like, no.
Well, I'm
Yeah.
gonna go in a little different direction here. I feel like sometimes with first-time home buyers, they are expecting a lot more than they can get at first. And I just always try to remind them that this is your first home. It's a stepping stone. It's not gonna be your forever home, you know? It's a starting point. So another one would be 20% down. True or false? Do you need it?
No, you don't. That's false. So the whole 20%, I think, has started. It was a way to avoid private mortgage insurance. That's not a conventional loan, so you don't have to do. Even on a conventional loan, you can do as little as 3% down. So it's just a misconception that kind of got stamped in from long ago, right? And some of the banks or credit unions may have had that, as a staple where you had to do that, but it's just a myth. You can do, zero down. That's a USDA, VA loans. You can do zero down. So there's a lot of misconceptions.
So to avoid the private mortgage insurance, what is it 20%?
For
all
conventional-
across the board? Or
For
what is
conventional,
it?
it's 20%.
Okay.
There's different ways to get rid of it too. You can buy out of it,
Mhm.
depending on how much you're putting down. There's different tiers for that. If you put, 5% down, 10% down, there's different tiers where you can do a one-time buyout of it. It's really expensive, so it doesn't make sense most of the time to do that. You're paying for this buyout versus just paying towards, the closer you get to that 20% down, the cheaper it gets, and it's also based on credit score. So if you have really high credit scores and you only put 5% down, you might have really low private mortgage insurance, and people don't know that. So that's good to look at that, because once they see it, sometimes they're like, oh wow, I'm only paying $40 a month for private mortgage insurance, even though I'm putting, only 5% down. It's not that big of a deal.
Right.
And after a certain amount of time, are you able to remove it if you pay down a certain percentage of your home?
Yeah, so it'll naturally fall off,
Okay.
but when you pay it down by 22%.
Okay.
Of the original, purchase price, or a lot of lenders don't, and banks don't tell people this too. After 2 years of owning the house, you can get a valuation done on the property, and if you have 25% equity based on your loan balance and the value at that time, you can get rid of that private mortgage insurance without having to do a full refinance.
So,
Can you?
sorry, what would that entail? Like an appraisal? You have to contact your.
A BPO, from
Okay.
a real estate office. Yeah. So that's.
So the point of contact first would be your realtor,
Mhm.
then to you guys,
Yeah.
right?
Yeah, because you guys will be able to run those comparisons and see where the valuation can land. Sometimes the banks ask for that. They can go a step further if they don't necessarily think that that's enough. AVM, automated valuation mortgage, which
Yeah.
is just a fancy algorithm system that puts together those numbers.
Wow, I think that's a kind of a small missed opportunity that probably a lot of home buyers or homeowners don't know that they take advantage of. So.
Yeah. And you can accelerate that time too. So just like Ben said, where it's do that in 2 years, we have some very, eager buyers where they want to make those extra payments for that amount of time to get that mortgage insurance removed. And we have a lot of people, they say, can I pay it off sooner? Absolutely, please do. And you can accelerate the typical times that it takes to reach 20 or 25% equity.
Yeah. Well, especially if we're in a market where it jumps and we see a huge increase like we have, right? And right after COVID, like that would be a prime example of when you probably should have taken advantage of that and be like, hey, my house is worth more than it is. Let me try and, get this removed. So, okay, great.
I do want, since we're talking about mortgage insurance, you and I actually were talking about FHA the other day. So can we dig a little bit into that as well and how that works? Because I know we're kind of comparing two different lenders and wanted to look at the fees and what would be best for our clients.
Yeah, so super common misconception. FHA, if a lender puts you in an FHA loan, it's for a very specific reason. And one of the downsides of an FHA loan is that you have permanent mortgage insurance. There is a way to get out of that. And I always call it the 10-10 rule. You have to put 10% down on an FHA loan, and you have to wait 10 full years before that private mortgage insurance can be removed. So if both of those, that's why I always think of that 10-10 rule. It really makes it easier to remember in my head. 10%, 10 years, then you can remove it. Otherwise, it's for the full 30 years. So if we know that we're in a high rate market and we know rates are coming down, it can be worth doing just a conventional loan, maybe having a slightly higher interest rate for a shorter period of time because you know you're going to be refinancing. So having an FHA loan up front doesn't always make sense. It's typically for those newer first-time home buyers, maybe have had credit struggles, don't have as much money to put down. Those are the clients that are really better suited for those FHA loans. So really, as a lender, you want to make sure you're comparing FHA and conventional properly and not just put them in an FHA loan because it might be easier. That's silly.
All right, so let's dive deeper into VA home loans. So can you tell us a little bit about how unique VA home loans are and how it can actually be a powerful resource for our veterans?
Yeah, absolutely. We talk about it all the time, but one of my favorite features about a VA home loan, there's two actually, the zero down payment. It's a really great way to take care of our veterans, number one. Number two, zero private mortgage insurance. So everything we were just talking about with FHA and conventional and making sure to wait 10 years, all of that nonsense is gone. And it's a really great way to make sure we're taking care of those veterans. I would say there's like a slight downside, but it's all perspective and how you look at it, is the VA funding fee. That can make a difference if it's the first time you're using a VA home loan, the second time you're using it, it's called subsequent use. The only time there's an exception for that is veterans who are disabled. Through the Department of Veterans Affairs, when we order your documentation from them, we do have to confirm that it does say exempt from that VA funding fee. It can just be a certain percentage that gets tacked onto your loan. So it's not like the veteran actually is paying for it in cash, or having to figure out a way to get that money. It just gets rolled into their loan. So sometimes that can result in a slightly higher mortgage payment, but again, it's either slightly higher mortgage payment or no house because they don't have a down payment, etc. So I think those are some of the great benefits.
So as far as the funding fee, do they have to have a specific rating with the VA disability? Does they have to be 50%, 100%?
30% through the VA,
okay.
And then that's exempt.
Okay, so that actually opens up quite a bit, because I think a lot of people that do have, or veterans that have that VA.
Yeah,
they probably don't know something.
Yeah, and some think that, they have to be at 80%, and that's actually a common myth. A lot of people, or I've seen lenders think that it's 80%.
And is that something that you find, or do they need to tell you up front, hey, I have VA disability rating, or like, do you have that conversation with them?
We get it through the VA because we order a certificate of
okay, so you're going to find out regardless if they think about telling you or not.
Yeah, we ask the question no matter what. We have to ask, are you exempt or not exempt from the funding fee?
Okay, so that's good to know.
Yeah, and sometimes the veterans don't even know, and they're like, oh, I'm only 35%, disabled, so I have to pay for it or whatever. And we go, no, send your documentation to the
Yeah.
Department of Veteran Affairs and get your certificate of eligibility updated so that it reflects on our end properly. So we have seen that happen where they go back to the VA and then they get their rating changed. So we've
And
been
is
able to
that
help people.
every time they buy at that point?
Yes, we have
So-
to check every
okay.
single time.
And then, what about with refinance? Same thing, it applies?
Yes, the exempt, yes, correct. And it's subsequent use. There are lower funding fee rates for certain types of VA refinance loans, but we do have to check every single time. So we have access to the VA portal, so that's something that we're in there probably twice a day at least, checking on it. So yeah, we're pretty accustomed to the management part of it. Yeah.
Awesome. All right, so in regards to the VA home loan, can you compare the rates? So I know we briefly mentioned FHA, and then we have VA and conventional. So with all these different loan programs, what do the rates look and how do they compare to each other?
Yeah, I'll let them
So I'd say government loans, typically the rate's a little bit lower and it's a lot less stringent on your credit score. So for instance, you could have a 680 score, and on conventional, you're gonna get hit pretty hard on interest rate because the top tier for conventional is 760, it used to be 740. So unless you're in that top tier, you're not gonna get, the best rate. Whereas a VA or an FHA loan, you're gonna get a really good interest rate, and typically apples to apples comparison, I'd say it's about half a point to a quarter better on those. So it really helps out that borrower that doesn't have, perfect credit, but, they're entitled to the VA or an FHA loan.
Yeah, it sounds like if they qualify for the VA loan, then it's, the benefits are a lot higher. Just with the not having to come in with any money. And then I know we on the realtor side of things, we can negotiate seller concessions so then we can get your closing costs covered.
Right.
Now, can we talk about the entitlement and how that works? And because I know I personally have 3 homes with the VA. So I feel like there's a lot of myths wrapped around the VA home loan, and you can only have one house with a VA loan at a time. And I know that is not true at all because I have 3 homes that have a VA home loan. So can we dig into that and some myths that's wrapped around the VA home loan?
Yeah, absolutely. So I would say the reason it's a common misconception is word spreads quickly, and the fastest way that word spreads quickly is between other members of the armed forces, right? Where they all start chit-chatting about different things and they talk about their experiences and what have you. So again, super important to get with a lender who actually knows what to do with a VA home loan. But when it comes to VA entitlement, you have to reside in the property within 60 days of purchasing. So no ifs, ands, or buts. Now, it doesn't necessarily need to be the veteran or service member themselves, as long as a family member who is living with them can reside into the home within 60 days. So it's really great for those individuals that are deployed or transferring bases, getting the family set up, and the other service member can come trailing behind them. So as long as they reside within 60 days and they live in the property for a full year as your primary residence, you can then convert that into an investment and go and purchase another VA home loan. That's when you get into bonus entitlement. So we do special calculations that allow us to see how much entitlement you still have with the VA. And as long as there's still money available through the VA based on your existing home loan amount and your new home loan amount, you can absolutely continue using your VA home loan. It just can get more expensive at that time because the VA funding fee does go up higher on subsequent uses, unless of course you're exempt from the VA funding fee because of the disability rating. So just really depends on how you use it. You can structure it very well. You can even do refinances later down the road with VA IRRRL loans, so we can get that into that. So
okay, yeah, which I've done that, and that's really great. I don't think I'll ever refinance. I'm at a 2.25 on one of my own properties right now, and with a VA IRRRL, so it's it was really nice. I know there was another question. Okay, so the entitlement. I know with COVID times and everyone's equity just shot through the roof. Where is that entitlement at right now?
So bonus entitlement kicks in after a loan amount of $144,000.
Yep.
Yeah, so that's usually never a problem to engage into bonus entitlement. You'd have to have really, really, really large loan amounts, and where we've seen that come into play, at least in our current market, in Southern Arizona, I think after 500,000, doing that 2 or 3 times, then you might have to actually start putting in a down payment. So,
okay, so
yeah.
around 500,000 2 or 3 times.
Correct.
Okay,
Yes.
all
So
right.
really,
So
that
I
actually
might be able to buy my 4th house on the VA home.
exactly, or do a minimum or
Yeah.
minimal down payment in order to do that. But yeah,
Yeah.
it's just important to do that calculation, which we help with.
Okay,
And
so
let
I
them
do
know.
want to, I've had this conversation a lot with some of my investors because I think there are some gurus going around saying, oh, you can utilize your VA home loan and buy investment properties. But so therefore it creates confusion amongst some of the newer investors thinking that they can go and buy an investment property as an investment property with a VA home loan. So I just want to clarify things that the way to do that is you buy it as your primary and then you convert, which is how I did it.
Right.
You can't go and buy a property, correct? So do you want to touch on that and just kind of like
Yes.
clear the air?
Yeah, we unfortunately have seen it. Occupancy fraud is real, and it is probably one of the most prevalent issues we currently see in our market today. And it happens, unfortunately, with the VA loan, where they say, I'm going to live in the property, and let's say they have a beautiful 2,500 square foot gorgeous home, and now they're buying a 600 square foot home in not the best zip code of where they're living,
Yeah.
Based on their job and where their kids go to school. And we're like, so you're gonna move a family of 5 into a 2-bedroom home. Okay, why and how? Let's talk about this. We have been able to make things work where people are downsizing because they're, family member's going to come to live with them, and the current house they have has stairs, and so there has to be logical reasoning behind it to make it work. But we check those things, not just us either, right? Ben, the insurance companies are now knocking on your door to see if you actually live there, and if you don't, they can call your note, which means you now have to pay the full amount back.
Yeah.
It can be scary.
A true investment.
Or refinance into an investment. So you just have to be cautious. Live in the property is what I'll say. Live in the property for at least a year.
I mean, it's the same with FHA too.
Right.
So FHA, you can buy it, you have to live in it with 1 year, and then you can convert it. But it's not just single family as well. Let's talk about multifamily. You can buy multifamily, like duplexes and triplexes with the VA and FHA home loan. And I'm an investor and I work with investors. So there are creative ways to get into investing. And I know with my kids, I want them to buy a duplex, triplex. They'll live in one side for 1 year and then they'll move out and just kind of start the whole process over. But how does that work, especially if you're worried about, oh, I can't, duplexes are $500,000. How am I going to qualify? You use the income from one of the sites. Can we actually talk about that just a little bit?
Yeah, so both FHA and VA, you can do up to 4 units. So as long as you're living and occupying as a primary residence one of those units, we can use that rental income. So if there's leases in place or we get a rental analysis done, we can use that to help qualify. So even though it's more expensive, we look at the overall picture.
Offset some of it.
We can offset, yes.
Yeah.
Yep, and then you start building your portfolio. It's amazing. Real estate it's amazing.
Oh yeah.
So awesome.
Can we switch gears just a little bit? I'm going to direct this question to you.
Okay.
Have you had any experiences where sellers are less inclined to accept an offer from a VA buyer?
Not really, not at this moment. Now, I have had a couple properties that were distressed. So those properties would be the ones where we're not as open to VA and FHA just because of the appraisal process and then the repairs that would be required, but we're also selling those as distressed, quick sells, and gearing it more towards investors. Other than that, I try to have the conversation with my sellers. We don't want to lessen the buyer pool, especially if we're in Green Valley or Sahuarita, where there are a lot of VA buyers and FHA buyers. So let's just make sure that the house is in tip-top shape. We do any repairs that need to be done, and we move forward. But we don't, especially in the market we're in now, we don't want to lessen our buyer pool. So as long as the house is in not like major distress, then we keep it open.
Okay, because an VA appraiser and even FHA can call out repairs, conditions to close, correct?
Yeah, and
Okay.
they're not
Conventional as well.
conventional too. It's a really common misconception. Like you can't have your roof falling in.
Mhm.
You know, people think that conventional it'll pass. Okay,
Yeah,
it
the
won't.
home has to be in a livable manner for any loan type.
For
So
any
if there's any safety hazard, any of
Mhm.
those loans,
Mhm.
FHA, VA, USDA, conventional are gonna require that, but,
They all call it out.
VA can get a little, and FHA can get more tricky on like, the fascia
Mm-hmm.
and exposed wood.
Mhm.
So that's the big one that we
Yeah.
see with.
Because that can lead to wood rot, which leads to mold, which leads to damage. And so they're big on, is it safe? Because they know some of these buyers, FHA, VA, some of them can be first-time home buyers. So they're not, they aren't always the highest, most affluent clients that you'll see. Conventional, someone who's putting 20% down, they've probably purchased a home before. This is maybe their second or their third home. So sometimes the government entities are a lot more protective over those types of loans,
Yeah.
which I think is great for our buyers. It adds an extra level of protection and
So,
safety for them.
I think something to remember then as a seller is that these items that could be called out, the buyer probably is gonna ask for you to fix it anyway, so.
Yeah, exactly.
Yeah, we try to negotiate, I'm sure you as well, Christina, but we do the home inspections. And then the home inspections are gonna call out most likely what a VA appraiser would, which would be, we see a lot with the fascia, GFCI, smoke detectors and stuff like that, rot around door frames,
Right.
exterior door frames. And we try to handle that through the inspections, because for one, we don't want to repeat. We don't have to
Yeah.
pay for a second, time for the
Exactly.
appraiser to come out. But we try to negotiate that through the repair process so we don't have conditions on the appraisal.
Right.
Sometimes something gets found, that the appraiser, because it is just, every appraiser's different, they have their own opinions.
Right.
But yeah.
That's great.
So if a VA buyer has that option to use their VA loan, should they go a different route?
Well, it's gonna depend on their credit score, if they want to put money down, or what their entitlement is, regarding like the funding fee. So weighing those out and kind of looking at the whole picture, seeing, because again, VA can have a better interest rate than conventional. So if they're planning on putting money down and they do have subsequent use where they have a 3.3 funding fee that gets rolled into the loan, conventional might be better in that situation, especially on a big loan amount. That's 3.3% of the purchase price can be pretty hefty, right?
Very
So,
hefty.
Look at the whole picture and then showing them to make that decision.
That we had that recently. A buyer was large loan amount. He was putting more than 20% down because he got an inheritance, and he's like, "But I want to use my VA home loan." I'm like, "It's going to charge you $17,000 for your funding fee for no reason. I get you want to use it, but it's not actually benefiting you." So having really smart team is really, really crucial.
Good lenders that know what they're doing
Yeah.
and look at everything.
Yes.
Okay.
I
Exactly.
agree on that. I had the same thing. It was, I think 750 was and they were putting almost 50% down because they had just sold $1 million home and they were moving a bunch of that cash.
Right.
And they wanted to use their VA home loan, but then after looking at both programs, conventional, it just made more sense to go conventional route because of the amount of money they were putting down.
Yep.
They definitely still tried to kind of stick with the VA, but their lender, this was from Phoenix, I'm so sorry. It wasn't. But their lender had guided them, was like, no, it just makes more sense to go conventional. So they did, they went conventional.
Yeah.
So I think having a great lender, especially one that is pretty affluent with the VA home loan, because not all lenders are created equal. If you are a veteran and you do want to use the VA, for one, look at all different options and make sure you're working with a lender, such as Mayela and Ben, that are very fluent with VA home loans. So
It's important.
Okay, so if interest rates drop in the future, should buyers wait to purchase now or buy and refinance later?
I think it's a huge one for the market we're in right now.
It's a big
So yeah.
I'd say right now is a great time to buy because now you're getting seller concessions where during COVID, when rates were super low, you were in a bidding war, so you were, paying above value in some cases. Just to get under contract, and sellers were helping with closing costs. Now, at least you're securing the home at a good price, getting concessions, and then when rates do lower, you can refinance. So
Okay, and then as a first-time home buyer, we have DPA, down payment assistance, and we just had a new one roll out just recently, right?
Yeah, Arizona is home. So we've done it in the past, and the funding was gone. So the funding is back, which is really exciting. Most of these programs have a limited amount of money, and you better get in now, otherwise you're out on those different programs. There's a lot of other multi-state programs where we can use it regardless of where you're at, so it doesn't, just because you can't get into one program doesn't mean you can't do others. There's a lot of common misconceptions with down payment assistance, but it just really takes a good lender who knows the products to partner you properly with them. One of our favorites is the mortgage credit certificate program. That one gives you a tax refund, which is awesome. So we work with a local nonprofit called Community Investment Corporation. You can get over $50,000 over the life of the loan over the 30 years, and that's probably one of our favorite ones. It does require more paperwork and more legwork, which is why a lot of lenders don't do it, but we do it. It doesn't incentivize us in any way, it actually only helps the buyer, so it's a great program.
and we've actually used that to help people qualify sometimes, because it's a up to a $2,000 tax credit rebate they get, so we can count that as monthly income of $166.66. So if it's really tight, that's a little bit extra.
It's our little saving grace,
so
yeah.
You're getting the benefit of qualifying, plus you're getting that $2,000 tax credit for up to 30 years, which is 60 grand. So
Do you have to, if you use that tax credit, do you have to live in the house for a certain amount of time? Because I remember a tax credit several years ago, you had to live in it for, I think it was the Obama tax credit. You had to live in it for so many years. It was a much bigger credit.
Yeah,
but
I believe it does need to be your primary, you know, but the Community Investment Corporation, they're so well versed in the program, so anytime there's questions, I do recommend going to them, especially tax credit questions, because I'm not a CPA, so I'm like, go talk to your CPA, you know.
So with DPA and just kind of the market in right now and getting seller concessions, it's not unlikely that as a first-time home buyer, we can get you into the house with little to nothing down. Call me. So something else, I guess before accepting an offer, we did talk about this already. Just make sure, as you know, your seller's agent, look at that pre-qual, call the lender, make sure they're qualified. It's a solid offer. Don't be afraid to pick up the phone and give them a call. With any offer, talk to the lenders.
So would you recommend that a buyer, if they're thinking about buying, meet with a lender first or meet with a realtor first? Because we know what generally happens. Most of the time we get the phone calls first. They have no clue what price point to look at.
Always a lender.
Well, I mean, they can call you guys, but before you take them out looking at houses, it's the best.
I always say lender. Always.
I think it's one of the common, because I like realtor because sometimes you get these out of state, and then I like working with, I think local, it doesn't matter where you are, but local lenders are the best. They know the area, they know the programs. You just went over some of the programs, and then the Arizona pre-qual. What I have issues with sometimes, we need Arizona pre-qual. I'm having to send forms to lenders that do not know how we work, and then I have to chase them down for loan size
and
updates
they're
and this and that.
24/7.
Yes, so I think it really doesn't matter where you start, but I think realtors, they do have a lot of resources and they know a lot of great local lenders. So if you start with a realtor, that's fine, but it is still very important to know what you're qualified for. And you could even be qualified up to $400,000, but you're only comfortable with a $350 payment. So just even knowing that and knowing what the numbers are and what you're comfortable with are really important.
Right.
Okay. All right, guys. So let's wrap this up. I want to end it with you guys. A lot of people, when they're thinking about buying, what do they need to come to the table with? Like, what are the qualifications to be able to qualify to buy a house? What do they need when they call you?
So it depends on the situation, right? Everybody's different, right? Because that happens a lot. There's like, well, my neighbor did this, or that everyone's credit situations, their income, their liabilities are different. So just having that conversation, doing the loan application, letting us review your documents is the most important part. for us to give you that information and let you know what your options are.
Yeah.
So work history, like what
Everything.
minimum of what
Yeah, I mean,
does it matter?
basics, name, date of birth, social, employment history, what properties you currently own. We do a deep dive on your credit. So at least I tell buyers, don't sneeze without telling me. If you're doing anything, we have to know. If you're transferring money, if you're closing an account, you're changing jobs, your tias, abuelitas on the second side, cousin or whatever is going to be helping and they want to gift you money. I have to know literally everything. If you think that it might be a problem and you have a moment of doubt, talk to your lender. Because I promise you, a lot of people think that they know, and they unfortunately don't. And sometimes, and I'll say it, sometimes they even go to their realtor as the resource, and they try to get the information from the realtor. And I'm like, no, everybody has to stick to their lane, because we're professionals in our territory, and you're professionals and experts in your territory, right? So that's how we partner together. As I say, you're asking me questions about this property, I have no idea. But you know who's great?
Yes.
Is Courtney and Christina.
And you guys have helped me out multiple times, which I'm sure you have, Courtney, as well, where, I had a client, they hadn't had a full solid 2-year work history because of certain things. So the credit union they're working with only qualified them for a lower amount. I sent them to you guys for a second opinion. You were able to get them qualified to the amount they needed. And so, not all lenders are created equal. There are realtors, so if you're looking for the best, give us a call.
The dream team right here.
So feel free to contact me. I'm Ben Ramirez at Fairway Home Mortgage with the Ramirez team. So we're happy to help answer your questions and look forward to talking with you.
I'm Mayela Cervantes. I'm a loan officer on the Ramirez team as well. We're a great team, so reach out.
And this is Courtney Seeley and Christina Carney with Realty ONE Group Integrity. You can always call us, and we've got some amazing lenders on our side, and we'll get it done.
The one great thing about our team specifically that we really want to address is Homes for Heroes. We signed up with a nonprofit that really helps our heroes in our community, veterans, police officers, teachers, nurses, those frontline responders that are taking care of our community every single day. We want to give back, and so we're part of this program that if you sign up with us specifically on Homes for Heroes, we'll ensure that there's some incentives for you for your purchase, and really it's just giving back to those, frontline individuals that help our community. So
And that have given so much.
Yeah, exactly.
Just a little bit we can do to say thank you.
So till next time, bye.
Bye.